Well, hi traders, Chris Weston here from Pepperstone. Sorry about the poor lighting. We're on a bit of a whistle-stop tour at the moment, and something we will get fixed for next week as well. But what I thought was an interesting exercise is to see what is essentially priced into rates and swaps markets. It will help us with our risk-reward assessment, along with things like positioning. It can also understand how the market may react to the various news events that we hear throughout the week as well. So something that I think is a worthwhile exercise. We do this on an ongoing basis. So first of all, I think it's probably interesting to understand that we do have, 7 different central bank meetings coming through this week. We've got the Chinese Central Bank meeting, and they should adjust their prime rates, their loan prime rates, on 1-year rates from 365 down to 355. They should take their 5-year rate from 430 down to 420, but there is some conjecture that perhaps they take that a little bit lower, perhaps cut that by about 15 basis points. Now, the market's obviously craving some tangible news around stimulus. We're obviously very high on expectations, so we'll see what happens there. We're going to be hearing from the Mexican Central Bank later this week. The market's thoroughly expecting them to stay at 11.25, but there are some risks further as we go out throughout the corporate calendar this year that the Mexican Central Bank do start to ease policy. The market's pricing about 60 basis points of cuts in Mexico between September and the end of the year. We're going to hear from the Brazilian Central Bank. They're expected to leave rates at 13.75% as well. And Turkey, we should see one-year repo rates being ratcheted up very, very, very aggressively from around 8.5% to 20%. Sort of going more mainstream, we're going to hear from the Norges Bank later this week. They're expected from the economist community to raise rates from 3.25 to 3.5%. The interesting conundrum here is the swaps market's pricing about 36 basis points of tights. So they're sort of very much on the fence that we could get a 50 basis point hike, and market pricing is somewhat slightly deterred a little bit away from economist pricing. That's the same with the Swiss National Bank. The median consensus, and certainly the strong weighted consensus, is the Swiss National Bank raised rates by 25 basis points to 1.75%, but the market's pricing in 34 basis points. So again, very much split. Do we get a 25? Do we get a 50 basis point? We could see some life in both the NOK and both the Swiss franc this week. Where I think it's interesting, if we go into the big banks that we cover and certainly influence our client positioning far more intently, the US, Australia, Europe and the UK. The UK is the one that jumps out straight away. Now, we've got a CPI print coming out on Wednesday. The market's expecting the headline print to drop from 8 down to 8.4%. It's the core number that interests as well. We're expecting that to be at 6.8%. Now, that could set the scene for further pricing around the UK rates curve going forward, because if you have a look at the UK rates market now, we've got 29 basis points of tightening being priced in for that 22nd of June meeting. So that gives you a fully priced 25 basis point. The market should not move then if we hike on that situation alone. But there's actually about a 16% chance, or 4 basis points, that they go up to 50 basis points increments at this meeting. That's not going to happen in my mind. I think the barriers for that are very, very high indeed. Where it comes interesting, if you go down into that August pricing, we can see that being priced at 506. So 34 basis points step up into the next meeting. So the market's saying we could get some data and things could continue to be very hot, certainly on the wages side of things, that could see them feasibly jump up to 50 basis point increments in that August meeting. And then we can see going out to February, the terminal price or peak pricing in UK rates of 577, so it's about 134 basis point cumulative being priced in. That's where we've seen that big move in terminal pricing. We've seen about 100 basis points or so being added over the last month, and that's where you've seen 2-year gilts moving up quite sharply and pushing 5% at the moment, actually moving up to about a 28 basis point premium relative to the US, and that's where some of that sterling strength's been coming through. So just take a look at that and bear in mind. I think that's what we're looking at for the statement this week. Will it marry up to what we're seeing in August? What does it mean for terminal pricing? US, in terms of data this week, got some splutterings of tier 2 data. We've got a few housing numbers coming through, the leading indicators. We've got jobless claims, but it's going to be the Fed that dominate here. We've got Jerome Powell, the Fed chair, speaking in front of the House and also for the Senate, as well as 11 different speakers in aggregate coming through. Now, we've got 17 basis points of tights being priced in for the July meeting, 26th of July. That's sort of 66% chance. And I think that feels about fair at the moment. If you look at the data that we've got this week, it's pretty light. I think we're going to have to probably push a little bit forward until we get the next core PCE number, which comes out on the 30th of June. The non-farms on the 7th of July, and then also the big one there, the next CPI print that comes out on the 12th of July. And then I think the market will be firmly of the belief, do we get a rate hike or not? I think that 17 basis points will be markedly different by that point. We've got terminal pricing, not too far above that. So the market's saying We'll probably get one more rate hike from the Fed this year, and then we're done. In Australia, we've got 16 basis points of tightening being priced for the 4th of July. That gives you a 62% simplistic sort of probability they raise rates, and you can go down to terminal pricing for RBA pricing of 464 in terms of where the effective rate could be. So that's nearly 60 basis or 57 basis points of tights being added on a cumulative basis until November. Now this week, not really a huge amount to focus on. We've got the RBA minutes coming through, a few sort of splutterings of data points, but I generally think, and also RBA Kent and Bullock speaking as well. Now, in terms of data going into that July meeting, we are going to be watching, CPI, monthly CPI numbers will be coming out. We've got CoreLogic house price numbers, and also retail sales will be in focus as well. But I think 16 basis points probably feels about fair at the moment, knowing what we know. In Europe, we are watching, pretty light on the data front this week. We've got 19 different ECB speakers. So again, that's going to be something that could move pricing around. As you see here from swaps pricing, we've got 24 basis points being priced in for the next meeting on the 27th of July. And then we reach a terminal price around 379 by October. I actually think personally, that some of those rate hikes still need to come into the market into Q4. I think that's still positioned a little bit lightweight, but we'll have to see how some of the banks fare going forward with all this money being passed over to the ECB and further tightening of stress tests playing through. I don't want to forget about what's happening in Japan. The yen's been getting absolutely hammered from pillar to post. We do get a CPI number print on the national level coming at the back end of the week, and that core number is expected at 4.2%. Again, that could have some big bearings as well. But another big week ahead. You've seen the rates pricing. Trader with Pepperstone.